Welcome to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. This week, we talk oil, money, and startups. In the second half of our show, Richard Swart from Crowdfund Capital Advisors discusses the promises and pitfalls of financing new ventures opened up by the Jumpstart Our Businesses Act. Up first, John Tamny, editor of RealClearMarkets.com, political economy editor at Forbes, and author of the upcoming book Popular Economics, explains why he believes the recent plunge in the price of oil is entirely a monetary phenomenon. John, welcome to the show.
Thanks. Great to be here.
John, I asked you on to talk about oil and money, and those are two topics you write about quite a bit, and you take quite a contrarian view on it. Why don't you start out by helping us understand why we're wrong about why the price of oil is dropping?
Well, the common commentary today is a couple things are driving, or actually three things are possibly driving the decline in oil. One is that OPEC has lost any control over the market. Another is that the global economy has weakened such that demand for oil has declined, and that's led to a drop in the price of oil. The third is that fracking innovations have brought so much oil out of the ground that supply has outpaced demand. And my commentary shows how all three suppositions are wholly false.
Well, let's take that one at a time, because there are so few people that agree with you or even look at it that way. Take that apart for us one at a time.
Okay, well, the first one is OPEC, and that's a simple one. OPEC was formed in 1960, but where were the rising oil prices in the 1960s? They did not happen, which calls into question the notion of OPEC having market power.
What share of the market did they have back then? More than now, didn't they?
Certainly they did, because so many countries that were not part of OPEC hadn't yet discovered the oil yet. So back then their market power theoretically was much higher. But if you look at the 1960s, the price of oil was flat. In 1971, the price of oil began to spike, and it did so throughout the decades, and people tied that to OPEC's market power. The problem with such an assertion, of course, is that in the 80s and 90s, the price of oil plummeted. It fell all the way to $10 a barrel in 1980.
In inflated dollars.
1998. And so you'd have to ask the question, was OPEC merely feeling generous in the 80s and 90s? And then suddenly, in the early 2000s, oil started to spike again. Was OPEC re-exerting its market power? But if you believe that, what explains the big drop recently? This tells us fairly clearly that OPEC couldn't control the price of oil on its very best day.
So your point is, if it can't describe history, how can it describe the present?
Absolutely.
Okay. And what was your second point about fracking?
Well, fracking is the other popular supposition. As they say, what's driving the price of oil down in the present is that in the U.S. specifically, we've discovered a new way
flood of supply
to bring oil out of the ground, previously uncoverable oil, and that's expanded the supply versus demand for it. It's an interesting concept, but wait a second. Thanks to fracking innovations, the amount of oil extracted from U.S. deposits rose over 50% per day from 2005 to 2013. So we've had a massive increase in supply, but let's look at the price of oil during that time. It was $50 a barrel in 2005. By 2013, oil was trading at $89 a barrel with all this increased supply. So that kind of puts to lie the popular assumption that supply is what's driving the lower prices today.
And the last was the worldwide economy slowing down, which it is, isn't it?
No, I don't think it is for a second, but this one's my favorite because they're trying to say that reduced demand globally is what's driving the price down now. That's interesting, but when was the economy weakest in modern times? I think most people would agree it was from roughly 2008 to 2012. Okay, well, during that time, the price of oil was skyrocketing. So are people going to say that, in fact, the world economy is weaker right now than it was in 2009 and 2010? I don't think anyone can seriously make such a supposition. And so to tie a weak global economy to the lower oil price is arguably the weakest of all the arguments.
You're killing this narrative with logic, which usually doesn't work, right? Usually the only way you can kill narratives is with a counter-narrative. So what is the other explanation for what's going on?
Well, the other one's basic, and it explains why oil prices are lower. Oil is priced in dollars. And so let's look throughout history. In the 1960s, the dollar had a stable definition as 1/35 of an ounce of gold. With the dollar stable, commodities were generally stable. Oil traded about $2.30 a barrel. In 1971, President Nixon made the decision to delink the dollar from gold. That was tantamount to a dollar devaluation. So the dollar measure in which oil was priced went into free fall. No surprise that there were oil shocks in the 1970s. There were not OPEC shocks. There were not Arab embargo shocks. Commodities across the board were rising.
It wasn't just oil.
Oh, yeah.
I remember.
Wheat, meat, soybeans,
everything.
You name it, across the board they were rising because the dollar was weakening.
So was OPEC just doing a PR campaign at the same time?
The amazing thing about it, and no one talks about that, is OPEC sent out a resolution saying, we don't control this price, but if your monetary policy changes such that the dollar is devalued, this is going to explicitly lead to higher oil prices. But OPEC couldn't control that. Oil's priced in dollars. With the dollar weak, oil got expensive. But in the 1980s, Ronald Reagan was elected president. Presidents get the dollar they want. He was for a stronger dollar. Markets complied. Big surprise. Oil plummets in price. Was that, again, OPEC feeling generous? Was that new fracking advances?
No.
Well, neither one occurred, but the dollar was stronger, so oil plummeted. President Clinton, to his everlasting credit, was similarly a strong dollar president. Oil hit a modern nominal low of $10 a barrel in 1998. Was, again, OPEC wasn't being
Was
kind.
that in nominal dollars or in 1960s dollars? I don't remember.
Oh, that was in nominal dollars.
Okay.
But when you consider how much oil had fallen, people were paying 87 cents a gallon for gasoline in 1998.
Right.
Imagine that.
That's right.
And let's also think back to that. That was after 20 years of an economic boom driven by a tax cut revolution around the world,
and tremendous growth,
shedding
everywhere.
Communism around the world, massive global growth, yet oil was incredibly cheap. And so this idea that a weak global economy would be driving down the price now just defies basic history.
So what's going on? If the story that's being sold fits none of the facts and fits none of the history, why is that story being sold?
I think people generally misunderstand monetary policy. They tend to ignore that which isn't obvious to them, that they tend to look at money as money rather than what they should look at as a measure. You know, I'm roughly 6 feet tall. In theory, if I were Kim Jong-un, I could make myself 12 feet tall by devaluing the foot, you know. Well, the dollar is like a ruler. It's like a foot. And in historical terms, the dollar had a stable definition as a measure. But in modern times, the last 40 years, with the dollar floating, that measure has changed in length in the way that a foot would change in length. Right now, oil's never become expensive in the last 40 years. What has occasionally happened is that the dollar in which it's priced has been reduced in value, thus oil shocks.
If you use gold as a metric, how does that compare to the price? How many barrels of oil could I buy with an ounce of gold over the years?
Oh, see, that tells a full new story, and that gets to the heart of what we're talking about. In 1971, when we were still on a dollar gold peg standard, $35 an ounce bought 15 barrels of oil at $2.30 an ounce. Fast forward 10 years to 1981, gold was at $480 an ounce, oil was at $35 a barrel. Still bought 15 barrels. Oil's price hadn't changed, just the value of the dollar had changed. Fast forward to 2000, this would be about 2011. Gold was trading at $11.76 an ounce. Oil was trading at roughly $79 a barrel, still 15 to 1. And so if you look throughout history, there's a powerful correlation between the price of gold buying roughly 12 to 15 barrels of oil. Now, it fluctuates at times, but if you look in the 70s, the price of gold skyrocketed as the dollar weakened. Oil spiked. In the 80s and 90s, the price of gold plummeted. And with that, the price of oil plummeted too. In the 2000s, look at what happened. A dollar bought 1/250th of an ounce of gold in 2001. By 2013, it bought 1/1900th of an ounce. No surprise that we would see rising oil prices.
So we don't have an oil problem. We have a money problem.
Absolutely.
Talking about the remarkable stability of the price of oil measured in gold reminds me of a story someone once told me that in Shakespeare's day, 1 ounce of gold bought you a fine man's suit. And today, 1 ounce of gold buys you a fine man's suit. That's a long period of time to have stability.
Yes, it is. And it's a reminder that we do not have an oil problem. We don't have an oil scarcity problem. The producers who extract oil haven't lost touch with how to get it to us. What we have had in modern times is a floating dollar problem. And with that, there are periods in which oil gets expensive in dollars, but in reality, if we were protecting the dollar, oil's price would be largely the same.
Well, let's drill into that for the rest of our time together. Why is the dollar strengthening, and exactly what does that mean?
Well, the dollar is strengthening, and what does it mean? Gosh, it could mean so many things. The first thing is, why is it? I have my theories. The first one is we have gridlock in Washington. If you look throughout history, gridlock is good for investors. What are investors buying when they invest? They are buying future dollar income streams. The fact that Washington can't do much of anything right now is great for the dollar.
We're safe for the moment.
We're safe for the moment from the mistakes of, let's be clear, Republicans and Democrats. Another thing that I think history supports in terms of a stronger dollar is that two pretty substantial wars are largely over with. If you look throughout history, war is bad for business, as Joseph P. Kennedy liked to say. It's also historically bad for currencies. We're not at war, and that's good for the dollar. Some would argue how much we're not at war, but we're not where we used to be. Let's also give the Obama administration some major credit here. Quite unlike the Bush administration, the Obama administration has been very quiet about the value of the Chinese yuan or renminbi. This is reminiscent of Bill Clinton's Treasury under Robert Rubin. When he was Treasury Secretary, not once
Leave it alone.
did a responsible Treasury official ever complain about the value of the yen. They never jawboned the Japanese. It was a very powerful signal to the markets that we believe our rhetoric about a stronger dollar being in our best interest. I think in an odd way, we're seeing something similar today from the Obama administration.
Let's drop back for a minute. We just went through this tremendous QE phase. The Fed balance sheet has ballooned, as far as the eye can see. The world is awash in dollars. How can the dollar be strong?
Well, because the dirty little secret is that the Fed cannot increase money supply.
Whoa. What?
The Fed cannot increase money supply.
You're making me crazy here. Explain why.
Money supply is demand driven. My Frisbees for your dollars. My car for your dollars. The Fed can't push money into the system.
It's been trying.
It's been trying, and it's the stuff of myths. What the Fed has been doing, and this is in fact much worse for the economy, is it's ascribed to itself the right to allocate $4 trillion of wealth we've created. That is what quantitative easing is. It's the process whereby the Fed doesn't print money. It borrows money from banks that have excess reserves at times, pays them 25 basis points for them, and then goes and buys U.S. treasuries, buys U.S. mortgages. So the Fed, with the wealth we've created, has subsidized government spending, and it's also subsidized a blast to the past, a rush into housing. We know how that ended back in 2008. And so there's the Fed hasn't increased money supply, but it's allocated enormous sums of capital. And if you believe that's stimulative, and I know you don't, you believe that Janet Yellen is more skillful at allocating the economy's limited resources than are you, me, Paul Tudor Jones, Peter Thiel, Warren Buffett. We know that's not true, and so you think about the tragedy of quantitative easing is all the economic growth that didn't take place.
So it feels so good when you stop banging your head against the wall. The Fed has stopped pissing away money, and that's why the dollar's getting stronger.
It's a big factor. In not reappointing Bernanke, and let's face it, the Obama administration telegraphed that it was not going to reappoint Bernanke, really going back to 2011. Notice how the dollar started to strengthen versus gold around that time.
But Yellen's a dove.
Yellen's a dove, but there's a big, big difference. The Fed operates based on consensus. At the Supreme Court, it's perfectly normal to have 5-4 votes. You cannot have 5-4 votes at the Federal Reserve. If you get one, that is tantamount to you having to resign. And so with there no longer consensus, even inside the Fed, about the good of quantitative easing, Yellen's ability to do the damage to the economy that Ben Bernanke did has been greatly reduced. In her perfect world, she would continue QE as far as the eye can see. Notice how she can't do it. Notice how she is dialing it down. It's obvious she wants to. She has no consensus to continue imposing that damage on the U.S. economy.
So you think the Fed's on autopilot right now, and we're going to see the interest rates rise they promised?
Far more. And let's face it, interest rates are ultimately going to be set in the free markets as is. But with the Fed doing less, is it any surprise that markets are rallying so positively? It's also a signal from the Obama administration not reappointing Bernanke that they no longer support the implicit policy of devaluation. They've put someone else in place who can't do much of anything. That's bullish for the dollar because it's bullish for the economy.
So basically you're back to your gridlock story.
Love it. Gridlock. If you give me gridlock, I will give you a bull market every time.
What's going on with the euro? I mean, it's going in the opposite direction.
Well, some of that, let's face it, the euro used to buy, was at about 80 cents on the dollar. It got all the way up to roughly 150 on the dollar. I think the story there is vastly overrated. Let's face it, the dollar has strengthened once again substantially. And so is the euro weak, or is it merely not as strong? Yes, I would say it's just merely not as strong as the dollar. So I think the big story is that in technical terms, the economy is weak in Europe. Let's talk in a few years. I'll bet a lot that Europe's economy is strengthening alongside ours, that this currency differentiation hides the fact that with stronger currencies in both Europe and the U.S., you're going to see more and more investment in the ideas of the future rather than a blast to the past, including exploration for oil.
What about Europe's sovereign debt problem?
The sovereign debt problem, I would argue, is going to take care of itself with this higher growth that I'm talking about.
In Greece?
I would argue that, let's face it, Greece was on the euro. Over the last, 12 years, with the dollar weakening, the euro in gold terms has weakened quite a bit itself. That was the bad economic situation that led Greece to the precipice. I would argue to you, and I think history is going to bear me out, that with a stronger dollar, you're going to see a revitalized euro, and you're going to see growing economies throughout Europe such that that debt for governments is no longer a problem.
So with the exception of the fiasco caused in the mortgage market, which is a Fannie Mae, Freddie Mac story, separate story for another day, everything we've experienced in the last decade, you're telling me, is monetary driven.
I think most of it is. And the dirty little secret is that, in fact, the inflation that people keep asking, where is the inflation? The inflation already occurred. The traditional dictionary book definition of inflation is a weak currency, a weak dollar, a weak euro, a weak yen. Well, we had it. That was the malaise. That was the slow growth rush into the consumption of housing. It was also the slow growth rush into extraction of a commodity like oil that, let's face it, the most backward countries in the world are capable of doing. Getting into oil was our malaise. Our energy renaissance was the sign of a weakening, backwards-looking U.S. economy because in chasing oil, we were chasing the profits that Russia can get, that Equatorial Guinea
really
can get,
crummy business.
Nigeria can get, that tragic companies like Venezuela can get. With a stronger dollar, we're going back into the ideas of the future, the stock and bond income streams representing future ideas, technology ideas. We're talking about ideas that the rest of the world doesn't have the capabilities of doing. Is it any surprise that alongside the reversal for commodities, that the U.S. economy is starting to take off?
So you think we need to redirect the flows away from North Dakota and back to Silicon Valley?
Yes, but not in the tradition. I don't want to redirect anything. I think we're both for free markets. I want stable money values, and with stable money values, markets will decide. And what you'll see them decide very quickly is that North Dakota is yesterday's work. You can import oil from anywhere in the world, and they will redirect toward the ideas of the future taking place in Silicon Valley, Austin, Texas, Route 128. This is what we're comparatively best at, and that's why when the dollar is strong, the U.S. economy booms.
John, let's move over to China. Are they facing a bursting bubble there?
I think it's hard to make that argument. I think what we should instead say is what's happening in China is arguably the greatest, happiest story in our lives that we'll ever witness.
That's actually true.
A formerly poor country embracing the profit motive.
Not just poor. 1 billion of them were chanting death to America when I was a kid.
Absolutely.
Now they're making us underwear and iPods.
And think about this. They are making us underwear and iPods, and that gives us time to create Google, Intel, Microsoft. If China didn't exist, we would have to invent it. Every single day the Chinese get up in pursuit of wealth is a day that Americans get a raise. And not just a raise.
And they're working their butts off, too.
They're working like crazy, but even more exciting than that is that every day they work means that Americans get to migrate into higher and higher and more productive pursuits of wealth on the way to better income for every single American. Let's face it, China's been globalizing for the past 30 years. Has that led America to breadlines? No, we've become a richer and richer country as we leave some work to them and expand to higher pursuits.
Not all of us. Some of us are doing quite well in the knowledge economy. What about the folks being left behind here in the U.S.?
I would argue that those two are unrelated. If we had good economic policy, and we know what that is, those not in the knowledge economy would not be left behind. Let's face it, Apple, I think it employs roughly 15,000 people, but that doesn't begin to tell Apple's impact on the U.S. economy and on the economy around Cupertino. What about all the roofers employed by Apple? What about the investment bankers? What about all the lawyers? What about all the yoga instructors? The list is long from lower paid jobs to higher paid jobs that are the effect of Apple's success. This describes what's happened in Seattle with Microsoft. If you let the knowledge economy roam, you by definition are expanding the non-knowledge economy.
So as the knowledge workers have more money to spend, they buy more services, how can the government make sure these people aren't left behind?
The government can make sure they're not left behind by quite simply leaving them alone. Stop devaluing the dollar. Stop over-regulating them. We're talking about hair braiding services where you actually have to get approval from the government to do it. Look at Uber, which in and of itself might be the greatest economic lesson ever told to the American people.
It is a great story.
Yet governments are trying to get in the way of it. I think Uber's ultimately going to win. But why would you block something that has been such a source of employment for people who want...
For low-skilled people.
For low-skilled people. Yeah. It's a huge opportunity for them. So government's just got to get out of the way because the jobs will be created. I'm in the internet business today. I don't have a clue about technology, but I evolve with this economy. You don't know what the future jobs are. It's so interesting to go into shopping malls today near these knowledge companies like Apple. You know, one of the interesting things you see are hair places where you get your hair blow dried, a dry bar.
Yeah.
Nowadays, who knows why, but the rich no longer wash their hair. They want to go get their hair washed.
And blown.
And so you think about that. The nature of work keeps changing, but with those changes, there's more and more opportunities for those who aren't part of the knowledge economy. I'm not one of those, but I would love to work around these companies.
John, even so, a gap is still growing. Some people are living very well. Some people are barely getting by. And there are demagogues out there that are gathering up the people that are barely getting by. What happens if they take over the government?
Well, I don't think they ever will in a country like the United States. Americans love growth too much. But, you know, a couple things have to be said here. The wealth gap is beautiful. The wealth gap is the surest sign that someone like me, who's not among the 1%, is increasingly getting to live like the 1%. As the wealth gap grows, the lifestyle gap shrinks. And then after that, I think we have to ask ourselves the question. It's easy to demagogue the 1%ers, the people taking the risks on the new ideas. But would we be happier? Do we really think we'd be better off if Bill Gates, if Jeff Bezos, if the late Steve Jobs had been layabouts? Certainly the wealth gap would be smaller. Yeah. But I think we know the answer. Our lives would be unrelentingly worse off. We'd live lives of unrelenting drudgery absent the innovations of these 1%ers who invariably increase our lifestyles.
But go back to your comment that I thought was interesting. You said, as the wealth gap grows, the lifestyle gap shrinks. What do you mean by that?
I grew up in Southern California. Back in 1989, we went shopping on Christmas Eve, my dad and my sister for my mother. And we look up, and there's an obvious movie producer guy talking on this massive brick phone. We thought, oh my gosh, what is that? Who is this person? He must be really rich. Well, back then, a brick phone cost you $3,995. You paid roaming charges. You had to be very rich to own a phone. Nowadays, I look around, everyone's got a cell phone. I've got a phone in my pocket
elementary school kids.
that I can watch TV on, that I can get the internet on. That's the shrinking lifestyle gap. 10 years ago, no one had this kind of phone. Now anyone does. And so if you look at how people get rich, they tend to, because they are reducing the barrier between the haves and have-not, what they have access to. And so we should embrace the wealth gap. That means that those who are not in the 1% are increasingly living like the 1%.
So, John, what's the lesson for us in the gyration of the price of oil?
The lesson's a pretty basic one. We talk about jobs all the time and job creation. Well, it's got to be remembered there are no companies and no jobs without investment first. What are investors buying when they invest? They are buying future dollar income streams. And so if you want the plentiful companies and the jobs they create, you must stabilize the value of the dollar so that investors have every incentive to put that money into experimental new concepts like companies. If the dollar is weak, they put it into hedges, they put it into land, they put it into housing that does not increase the capital stock that leads to job creation. Let's stabilize the dollar, and in doing so, we'll get cheap oil and also abundant job creation.
John, thanks so much for coming on and sharing your perspective.
Thank you for having me on.
That was John Tamny from RealClearMarkets.com here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. Check us out on Facebook or follow us on Twitter at RealClearFrezza. And stop by RealClearPolitics.com, one of America's top political websites. Ahead, Richard Swart explains why the government only allows rich people to invest in startups.